right, well, welcome everybody to the Elevation Market Update. Everyone will be muted today, so this will be recorded, as I said. So we have a couple people joining us live, and then we'll be sending this out afterwards as well. This afternoon, we're pleased to have Don Anino of Lord Abbett Investments with us. He will be giving a 10-minute slide presentation. And Deborah's out on vacation, so I'll be presenting her questions to Dawn today. If you have any questions, feel free to put them in the chat and we'll try to get to those too. All right, so let me first tell you a little bit about Don. He joined Lord Abbett in 2006 and works closely with portfolio managers and analysts. And before that, he was a financial advisor. He lives in East Brunswick, New Jersey with his wife and 2 sons. So I will go ahead and turn this over to Dan now.
Okay, great. Thanks, Natalie. Thanks, guys, for spending some time with us. It's nice to see you. And what I'm going to do, let me share my screen and let's talk a little bit about what's been going on in the markets. So let me just get this up here. And there we go. So I guess where I'd like to start is, let's remember one of the sayings in finance, it's time in the market, not timing the market, right? So what you're looking at is a long-term chart of, just basic asset classes to make up your portfolio asset allocation. And it's small stocks, large cap stocks, bonds, and T-bills as sort of a proxy for like money markets. So as you can tell, the longer the more risk you're willing to take, the more you're compensated over time, and there's been no other proven way to grow your wealth over time than through your investment portfolio with following an asset allocation strategy. Of course, though, there's years like this one. And this has been a particularly difficult year for a number of reasons that we'll discuss. So what I want you to, though, also take into account is that over the last 73 years, there have been 13 bear markets. And a bear market is basically when a major stock market index is down over 20%. So 73 years, we've had 13 bear markets. On average, the market pulls down by about 25.5% in an average bear market, and the average bear market lasts about 7 months. So this market that we're in has lasted so far a little over 7 months, about 7.5 months. To the low level that we saw in the S&P, the market was down 24.5%. So we're kind of like in that average bear market place right now. We're down about 25%. This is about 7 months that we've been going through this. Could it last longer? Sure. But here's the positive part of the message. So while there have been 13 bear markets, there have been actually 14 bull markets. But here's the really good part of the story. In the typical bull market, you're up 136%, and bull markets tend to last 50 months on average, which is a little over 4 years. So to put some of that information together, to give you an idea of why staying invested is so important. In an average bear market, remember, you're down about 25%. But in an average bull market, you're up 136% over 4 years. So what that means, if you go through that drawdown of down 25%, but you hold through the bull market that comes after, you make all your money back and you double your money in 4 years, right? That's how the return profile looks. When you have an average of, again, a 25% drawdown followed by 136% recovery, it erases all of those losses and allows you to double your money within 4 years. So that's what I want, what people are going through, and obviously a very difficult market to remember and take some comfort in. We're long-term investors. You're working with a great team with your investment decisions and your asset allocation. What I would also point to is what's made this market so difficult this year is the Fed basically got the inflation call wrong, right? The Fed was very complacent. The Fed really didn't expect inflation to be as high and severe as what we're going through. So most of last year, they were very, very, again, kind of complacent and somewhat dismissive that inflation was going to become a real problem. And how I would point to that is last year, this time, a 2-year treasury was yielding 0.2%, 20 basis points. This time last year, the market, when I say the market, Fed funds futures were pricing in the first Fed rate hike would take place in June of 2023. Fast forward to today, right? Things are very different. A 2-year treasury is yielding 3%. So you went from 0.2 this time last year to 3%. That's a lot of rate pressure on the market, guys. That puts a lot of pressure on bond prices. And now we know that not only is the market pricing in more rate hikes, we've already lived through a couple, right? We had a 25 basis point hike, followed by a 50, followed by 75. And most expectations are when the Fed meets at the end of this month, they're going to do another 75 basis points or 0.75%. That's basically what is being priced into the market. So that's why this has been so difficult, because there's been nowhere to hide, right? This high inflation forcing the Fed to be a lot more aggressive with interest rates. Of course, that puts pressure on your bond prices. I think that is pretty straightforward to intuit. But it also puts pressure on the value of earnings. It puts a question on how profitable companies will be in this inflationary environment going forward. So this time last year, the S&P 500 was trading at about 24 times forward earnings. So the PE ratio as we went into the summer of last year on the S&P was 24 times expected earnings. We have now been pushed down to about 16 and a half times. That is very much in line with the 20-year average. Now it was worse, a couple weeks ago when the S&P, hopefully hit a bottom. But what I'm trying to convey is that we have absorbed a lot of price pressure. This has been a very strong price correction. And again, what's made it difficult is there hasn't really been anywhere to hide, because there's been pressure on stocks, there's been pressure on bonds, there's been pressure on commodities. Absent energy has held up pretty well. So it's been very difficult to find an area, to hide out in. But the good thing is, we've been through periods like this before. So what I want to remind you is there's always a reason to be nervous, right? Looking back, there's always something to be concerned about, whether it was the tech bubble in 99 into 2000, whether it was the terrorist attacks of 9/11, the subprime mortgage crisis, followed by the Great Recession, followed by the US government debt getting downgraded, followed by the COVID global pandemic and recession. And then, of course, now we're fighting with 40-year high levels of inflation, but the market tends to perform through here. So that's where I want people to take some comfort. So I'm going to just switch screens real quick, because I want to show you this other picture. So what this chart is showing, guys, is the total earnings of the companies in the S&P 500. So this number right here, $140.46. Those are the total earnings for the S&P in 2020. So that's the COVID recession, right? That's the pain of the global pandemic and the shutdown. This is last year. This move from 140.46 to 208.49. That's this massive recovery. I mean, that's a legitimate V-shaped recovery. Earnings came roaring back. The economy came roaring back. And then this is where we are right now with the expected earnings for the year at $230.52. So if you'll notice, that makes a pretty interesting kind of consistent line going all the way back to 2017. So this number from 140 to 208, that's like about a 47, 48% earnings growth rate, which I think most of us know if we've been following the markets, 48% per year is not sustainable, right? That's an incredible level of earnings growth. But from 208 to 230, That's more in about the 9 to 10% range. That's more in line. Remember, the first chart I showed you, the long-term return of stocks for decades has been about 10%. We're back here to expecting about 10% earnings growth. So it has been a very difficult year. Prices have been pushed down. It's been made even more difficult that bonds have been pushed down because of interest rates. We understand it's been a very much a challenge, but earnings have been holding up. We're going to start getting earnings for second quarter literally today. So our view is that earnings should continue to grow, maybe not at the same level as last year, but we think we've absorbed a huge amount of this price correction. Again, we're basically showing the metrics of a traditional bear market, but earnings still look pretty solid, and we're very positive about the potential in the second half of the year. So let me stop sharing there, Natalie. I know we wanted to kind of keep the opening comments to about 10 minutes. I think I'm more or less on time. So let's see, where we'd like to go next.
Yes, and before we head into the Q&A, I actually just need to show you a quick disclosure that I forgot to pop up earlier.
Okay.
All right, so basically this is just saying that we are not affiliated with Kestra IS or Kestra AS. And then there's also a QR code if you would like to, if you want to scan it and get more information on our disclosures. All right. Okay. Well, thank you so much for your presentation, and also for reminding us that long-term financial markets continue to grow. Can you tell us a little bit about how Lord Abbett Mutual Fund Management, like what your approach is by the portfolio managers?
Sure. So a couple of the core tenets of Lord Abbett, we're firm believers in active management. That means in all of our portfolios, we're making investment decisions about buying and selling, whether it's a stock portfolio or a bond portfolio. But we believe that we have the tools and resources to make investment decisions to over time outperform the broader markets. And we use bottom-up fundamental research at the company level, and that's true for stock research and bond research. And we also use quantitative data to make decisions about allocating portfolios and making sector rotation decisions. So it's a combination of fundamental research and quantitative research, and very much an active approach to management.
Yes. So like Don said, even when we say to you as clients, let's stay the course, let's be patient and wait for the markets, our mutual fund portfolio managers, they're doing things actively all the time. So right. Let's talk a little bit about what's specifically happening with bonds right now.
Yeah. I mean, it's been, gosh, at the risk of overstating it, this has been the most difficult year for bonds basically in modern history. And you literally have to go back to the Great Depression to see anything of this magnitude. And again, it's because the inflation pressure was allowed to build so long, and it was further aggravated by basically this prolonged zero interest rate policy, that now there's this correction in the bond market. So it has been really difficult. And again, I used the reference point before of a 2-year treasury going from 0.2% to 3%. So that's been across the bond markets. There really hasn't been a part of a bond market that was, let's say, insulated from that readjustment of interest rates. But there are different things going on. For our point, from our point of view, I should say, shorter maturity bonds, particularly taxable bonds, appear that they have adjusted appropriately. So a 2-year treasury yielding 3%, the market right now thinks that Fed funds will get to, right now it looks like about maybe 3.5%. And just to give you a point of reference, right now we're between 1.5 and 1.75, right? So basically the market's saying the Fed might raise another 1.25, 1.5%. What's very interesting is in the second half of next year, the market is projecting the Fed actually might take a couple of those interest rate hikes back. So they might actually cut by a quarter or so in the second half. So we think shorter maturity bonds are more appropriately priced given that view of what we think the Fed's going to do. Intermediate is tougher to say, right? Because we have inflation that is running, over 8%. Now we're going to get a CPI number tomorrow. So it'll be interesting to see if it shows any signs that inflation is starting to level off and maybe perhaps come down a little bit. But if we have a 2-year treasury yielding 3.05, that's about where we are today, and a 10-year treasury yielding 3.10, for that 8 extra years of uncertainty and interest rate risk and locking up your money to only get 5 extra basis points, it's hard to get excited about taking that extra risk. So for now, we think staying short in taxable bonds makes a little bit more sense than extending your duration, because you're not being paid any extra money for taking all that extra risk and locking your money up, for a longer period. Municipals are interesting. What's tough about municipals is they were so popular last year. Like last year was a tough year for bonds. The Barclays aggregate, so that's the broadest index for U.S. Dollar denominated debt, right? That's our big bond market index. It was down last year. Munis across the board were up because people just kept investing in munis and just basically keeping those prices high because they were in such high demand. So this year munis adjusted. So munis have sold off, and what's difficult is you've been basically seeing selling pressure all year, Natalie, in munis. Like money has come out, with the exception of I think 2 weeks, money has come out of municipal bonds. So that's where the volatility has come from. But the important thing to remember is, from a credit standpoint, the municipal market has never been stronger, right? The average growth, when you look at the 50 states and 100 biggest cities, for last calendar year, last fiscal year, on average, their revenues grew by about 20%. So they had a monster year of revenue growth. They have, definitely moved beyond the recession. And in addition to that, think about this: the municipal bond market is a $4 trillion market. That's all the municipal bonds in the country rolled up into one amount. We provided, through the 2 big stimulus packages at the end of 2020 and the one in early 2021, $1 trillion worth of stimulus to the municipal bond market. So there are hundreds of billions of worth of unspent stimulus. You have states with record budget surplus. So there's no credit concerns in munis. This is all about the change in interest rates. We think it's a very good opportunity actually to add to munis at these levels, because munis are down, depending on your maturity or credit quality, somewhere probably between like 8 and 12%. We've never seen that type of an opportunity to buy municipal bonds, especially when the credit fundamentals are still so strong. So that's an area where we're very high conviction. So taxable bonds stay a little bit short. Munis look great. You really can't make a bad decision in munis. We would tend to say the longer part of the muni market looks a little bit better because you are getting extra income, right? If you go from a 10-year muni to a 20-year muni, or 5-year to a 10-year, you are getting paid more income. So it's worth moving out in municipal bond maturities at this point in our view.
All right, yeah, so there's still some areas of opportunity in bonds, even though it's been a rough year for them. So let's switch gears and talk about the Federal Reserve. We just finished the first half, so the big question is, what can we expect in the second half of 2022?
Yeah. What some of the sources are showing us, one specifically would be CPI swaps. So CPI swaps are a way to invest in the level of the CPI index, and swap CPI levels have been coming down. So basically what the market is saying is that they believe the Fed will get inflation under control. that's going to be, I mean, that's going to be key to the rest of our portfolio, right? We need inflation to come under control. We need to start coming down. And then we need maybe some clarity from the Fed that, they are, let's say, pleased with the progress that they're making in inflation. And maybe they can be a little less vigilant than they've been these last couple of meetings. So our view is that we do think inflation begins to come under, and you're seeing some signs of it, right? You are seeing some signs. You're seeing the prices of used cars come down. You've seen prices of some materials and some commodities start to come down. So there's some signs. Now, I mean, I don't want to overstate it, but sometimes you don't need to get better immediately. You just need to get less worse, and the market might take that as a very good sign. Right, because we're so prepared for it to be so bad, and it has been so bad that you can go to extremes. Right, people get very, very defensive. They're very, very pessimistic, and then you just get a little relief in literally, like I said, something just maybe not as bad as what the market expected. That might be all we need to have a strong second half.
Yeah. So, what about a recession? Do you think that's going to happen soon, or that it's already happening now?
Yeah, that's an interesting conversation. If it is happening now, it's very unusual. I mean, from the standpoint that you just haven't. Well, let's back up. A convenient definition of recession is 2 consecutive quarters of negative real GDP growth. We could see that, like we could come close, but that's kind of like, let's call it like cocktail napkin economics, right? There's more detail and more nuance. And the National Bureau of Economic Research that's the organization that declares if there's a recession. And there's actually 5 major components to a recession. Now, negative GDP growth is one of them, but also you typically see a major broad-based decline in employment. We haven't seen that. Like unemployment's at 3.6%. There's still 2 open jobs for every person looking for a job, right? Companies and businesses aren't out there looking to hire more people because they see a serious recession coming, right? They're doing it because they feel like they're losing money, right? Like I run a software company. Like I want, more programmers and software designers because I want to get the next version of my software out to market faster because there's so much demand. Or, I want to run another shift at my plant because I can't keep the amount of my product on hand to meet all the orders I'm getting. Or heck, I need, 2 more waiters, another bartender, because people are leaving the line for my restaurant and going somewhere else because they don't want to wait for a team. So that would be one of those signs that is kind of like contrasting with the view that that a recession is right around the corner. The other thing you see is a major decrease in consumption. We're a consumption-driven economy. The U.S. consumer is 70% of GDP. The U.S. consumer has been very resilient. The U.S. consumer is still spending. Now, yes, you're seeing a little bit of shift from goods purchases to services because most of us, didn't go anywhere for the last 2 years, and now we're, free-range chickens and getting to go out and travel a little bit. But certainly, consumer has been very resilient, and that's because the labor market's been resilient. So you haven't seen that crack in consumer spending. You're still seeing very strong corporate spending because companies, were very, very cautious about spending coming out of the COVID recession, but now they have to replace equipment, they have to replace, other consumables. The other thing is you typically see a big drop off in industrial production. So we haven't seen that either. So look, could we get there? Certainly. Look, we're always on our way to the next recession, right? Unless we're in one, but I would say for us as a firm, our view for now is that this will be the proverbial soft landing, meaning the Fed will take the steps necessary to get inflation under control. It will slow growth, but not to the degree that it would put us in a recession. And we're optimistic. Now, we do have to see how earnings come in over the next couple of weeks, and more importantly, we have to see how companies guide through the rest of the year. So that's going to be very interesting to see how we get that. But I would say the Lord Abbett view is that at least for the next 6 months, we're more in the soft landing camp. Is there a higher probability of recession at the end of next year? Yeah, there's probably a higher probability, but definitely not a certainty.
All right. So I think we have time for one last question.
Okay.
Our clients sometimes ask about cryptocurrency like Bitcoin. Does Lord Abbett offer that type of investment?
No, we don't, because they're not an SEC regulated investment. There's ways for us to invest in companies that will benefit from the development of crypto. So think like companies that provide crypto purses or provide a platform to trade crypto. So we can get some indirect exposure that way. We do believe that it will survive and play a bigger role, and there will very likely be more applications to blockchain technology. It's just very difficult to know what crypto is actually worth, because if it's a digital currency, I understand there's a scarcity value and there's a finite amount based on how crypto gets mined, but I don't know how to determine what the intrinsic value is of it, right? So it's interesting. It's something that we're definitely watching. There's ways for us to participate indirectly, but we're not direct buyers of it.
All right. So we are at time. Thank you so much, Dawn, for the great information today. I hope that everyone who's on the call finds it helpful, or if you're watching at home with the recording, that you did as well. If you have a question, I know we didn't have time for questions today, feel free to send one in and we can follow up with you individually. And our next Elevation Market Update will be Thursday, August 18th, and we'll have a guest speaker from T. Rowe Price.
Good. Well, thank you very much for having me, everyone. I appreciate your time, and hopefully we'll get to do it again.